Today we're diving into two important stock valuation metrics, PER and PEG, and I'll use a simple coffee shop example to make it clear. Let's start with PER. Imagine you want to buy a coffee shop. The asking price is $1 million. You ask the owner, how much profit does this shop make in a year? And he says $100,000. That means in 10 years you'll make back your investment. That's basically what PER shows, the payback period of a business. But PER has one big weakness. It doesn't reflect future growth. Let's compare two coffee shops, both with a PER of 10. Coffee shop A is located inside a residential neighborhood. Coffee shop B is located on empty land, but next year Tesla is building a gigafactory right next door. Now, which coffee shop would you buy? Of course, coffee shop B, because its profits are likely to skyrocket once Tesla moves in. See, PER doesn't tell you that story. Both A and B look the same, even though B has massive growth potential. That's why we use PEG. PEG is very simple. PER divided by future earnings growth rate. So if growth is high, PEG becomes smaller. And a smaller PEG means explosive future growth. Legendary investor Peter Lynch used PEG as a key strategy. He would buy when PEG was around 0.5 and sell when it was around 1.5. For example, in 2024, Nvidia's PEG was close to 0.5, even though its PER looked sky high. Why? Because growth was insanely strong. The denominator was huge. So on PEG terms, Nvidia actually looked cheap. Practical investing. Here's the best part. You can use tools to filter stocks by PEG. On TradingView, for instance, you can set a filter. Show me only companies with PEG less than 1. Then filter again. Only companies with a market cap above $200 billion. When we checked recently, the list narrowed down to giants like Nvidia, TSMC, and Google. So instead of guessing, you can screen for stocks that are both big and growing fast. To wrap up, PER tells you how many years it takes to break even. PEG tells you if that price is fair once you factor in future growth. So don't stop at PER. Always check PEG. It might completely change how you see a stock's value.